which are lower at this point in time. Our market master of the day is Pratik Gupta, CEO and co-head of Kotak Institutional Equities. Pratik, great to have you with us here back on the program. Appreciate your time. Just start with earnings first up, Pratik. What we got last week, now I'm using the word consumer very broadly. We got very different segments of consumer companies reported, but mostly earnings disappointed the street. Tech also numbers have been very mixed, right? Mid-cap, very divergent kind of performance. Some very good, some weak. Banking, we've seen numbers come through. Reliance is reported. What's your take overall? Which direction are estimates going, up or down?
Good morning, Prashant. Our view, unfortunately, is that estimates are more likely to go down. We're probably already at the low end of consensus. Our expectation for the Nifty earnings for FY23 are at 11%. And for FY24 and 25, we're at about 15% CAGR for the next 2 years. And our concern has been the areas which you pointed out. One is the consumer discretionary segment in particular, especially urban consumer discretionary, and also the export-oriented sectors, whether it's IT, chemicals, some of the auto ancillaries. And we think there's probably greater downside to the earnings estimates as we go into the March quarter and the June quarters, as the global slowdown intensifies. That in turn, we think will put even more pressure on the earnings estimates for the export-oriented sectors. And the consumer discretionary segment, likewise, we think for the December quarter, we've seen a weak set of numbers coming out so far. And even going into the March and June quarters, we think this weakness will persist. We don't see a trigger for a sharp turnaround in the short term. So earnings-wise, we are a little bit cautious, and that's something, unfortunately, we just have to get past this next 1 or 2 quarters till we start seeing some acceleration in earnings.
Okay, so a bit cautious in terms of earnings. By the way, the market, the mid-caps at least, are now in the red. So there is definitely some caution in the system. Nykaa is down almost 3%. New lows on that one. Yes Bank is down about 10-odd%. And across the board, it's a bit of a lackluster opening, you'll have to say. It's not holding on to its gains around 18,100 or so. Pratik, hi, good morning. How are you feeling about technology stocks now? There were some star performers in the mid-cap and the large-cap space, but then again, you had some big losers as well. Are you buying here? Are you staying away?
Technology, I think, one, you have to differentiate between large cap and mid cap, and second, also in the various sub-segments some of these companies operate in. So in general, we think the large cap IT vendors are better placed this time around when you are seeing the end markets, US and Europe, going through a bit of a slowdown. And the mid cap IT companies are generally more vulnerable during times of discretionary spending coming down or vendor consolidation going on. So we prefer as a business the large cap IT stocks, and also they have last year the mid cap IT had a very strong run. We think it's going to reverse this year. And the other segment to watch out for is obviously the ERD segment, which tends to be a bit more vulnerable to an economic slowdown. There, the spending is a lot more discretionary. So avoid the ERD segments. But conversely, companies which are focused more on BFSI, there we think the IT spending is going to be more resilient. We have major technology upgrade programs going on, the cloud migration, the new apps being built for the cloud, etc. So there's a lot of work going on over there. So it's going to be less cyclical for the BFSI-focused businesses. But the other segments like ERD, for example, expect a weaker performance. So preference would be more for large caps than mid caps, and preference would be for BFSI than for the ERD type companies.
All right. Hi, Pratik. Good morning. Pratik, I think the cement pack as a house, you'll have been fairly positive on that as a domestic play. Ultratech's numbers, well, they were pretty okay. But my worry is the cement prices haven't improved. And when you're talking about solid demand, and yet prices don't improve, that's a bit of a worry. We're already 20 days into January quarter, and the street was estimating a price increase in quarter 3 and a further price increase in quarter 4. Now, that's not really playing out. That could be a risk to earnings. Your view on the space?
So actually, we've been a bit cautious on cement as well for the last few months. We think, as you rightly pointed out, there's been a sharp increase in raw material prices over the last 6 months or so, and the price increases haven't panned out. Partly, there's a lot of incremental supply which keeps coming every year. That's one. And secondly, I think in the sector, there's one big change which is happening is in the competitive intensity with the entry of Adani and them taking over the Holcim Group companies. We think it's going to be difficult for the incumbents to take on price hikes as aggressively as they did earlier on. So the competitive intensity is increasing. As you rightly said, the price increases are not panning out the way they should have otherwise. And demand is okay. We're actually not so concerned about the demand environment. We think as the year progresses, especially in a pre-election year, second half of the year, we tend to see, cement demand in particular picking up, construction activity picking up. Obviously, this assumes a normal monsoon. So we're not that concerned about the demand, but we're more concerned on the supply side and also stock valuations. Some of these cement stocks are still trading at very expensive valuations now. They haven't corrected or underperformed as much. So we are a bit cautious on cement as well.
Okay, we'll have to thank you on that note. Thanks a lot for joining in and have a great 2023. Let's move on now. A lot of stocks in focus. So let's talk a little bit about that. Adani Enterprises, the 20,000 crore follow-on public offer will open for subscription on the 27th of January, so in a couple of days from now.